Hello everyone, I hope you all are doing well. Today's video is Unit 1, Lecture 2. So we are moving into what are the financial markets and institutions today. So this is a continuation of Chapter 1 and also discussing some of the SIE exam prep material, and I'll discuss the SIE exam first. So, what is the SIE exam? The SIE exam is the Securities Industry Essentials exam, and it covers basic securities industry information, which includes the structure of securities industry markets, regulatory agencies and their functions, types of products and risks, prohibited practices. But this is an exam that can really give you a leg up when you are entering the workforce. So with this exam, it costs $60. It is 1 hour. You have 1 hour and 45 minutes to complete the exam. For our class, well, first of all, why should I take it? So passing the SIE, again, is the first step towards getting a job in the securities industry. Oftentimes, you must pass the SIE to get other security licenses. Oftentimes, when you first start working at a particular company, the first exam that they'll ask you to take is, or that you'll have to pass, is the SIE exam. But it shows prospective employers that you've mastered fundamental concepts and that you're ready to take that first step into a new career. For this class, you will be required to pass the practice test. The practice test will be 4% of your grade. So this due date is in the syllabus. You have basically the entire semester, but we would like all of our students here at Ohio University that are finance majors that are entering the workforce. This is a great way to really set yourself apart from your peers, and it will help separate you. You're always looking for a way that you can separate yourself from other applicants to different positions. So already having this exam certification is one of these ways that you can separate yourself. So as a practice, we are requiring that you take the practice exam, and you're going to have to receive a passing score on this exam. Again, there are additional details in the syllabus about this exam, but why is this important? We are covering a lot of definitions and terminologies here today that are included in this SIE exam, okay? So this is just, what we cover here today is just a portion of what is covered in the exam. There's a full list on Blackboard that I recommend you take a look at and kind of become familiar with, but you'll hear me discuss the SIE exam a few times throughout the semester, reminding you that you must pass this practice exam in order to receive that 4% of your final grade. So moving into today's discussion, as I mentioned, a lot of this material is on that exam, so you'll want to become familiar with it, and it's also important for financial markets and institutions. But today's discussion is going to be laid out into 3 sections. First is financial markets. So what are they, and what are some different types of financial markets? Then we'll move into market participants, and then we'll go into financial institution and regulators. So again, this is a lot of definitions. I'll do my best to add information to these definitions to make it a little bit more interesting, but today is a lot of definitions, so please bear with me. Take notes when possible, and if anything is unclear, don't hesitate to reach out. So the first thing that we are going to do is discuss financial markets. So financial markets are usually defined or characterized based on the characteristics of the securities that are being traded in that market. The first type of security, or the first type of financial market, is a bond market. So a bond market, we know that bonds are a debt security. They are also called fixed income securities, but bond markets are where these debt securities are traded. You also have stock markets. Well, what is stock? Stock is a security that represents ownership claims in a firm. So equity claims in a firm. These are probably the two types of securities that you're most familiar with, bonds and stocks. But there are also derivative markets, where a derivative is a financial security whose payoffs are linked or tied to some underlying asset. They include futures, options, and swaps. We also have mortgage markets. A mortgage is simply a loan to an individual or entity to purchase real estate. Mortgage markets include things like mortgage-backed securities, if you've ever heard of that terminology or that type of security. And we also have the foreign exchange market. The foreign exchange is the exchange of foreign currency. Now, I went through these pretty quickly, just told some very basics. These are all going to be discussed in more detail in future sections. So the bond market has its own entire unit. Same with the derivative market. Those are are discussed in much more detail. We'll discuss the mortgage market and the stock market more in this Unit 1, and the foreign exchange market is discussed in Unit 3. So you will have a lot more information on these different types of markets as we progress through the semester. Now, within each of these markets, the first two things that you have, the first two types of market characteristics deal with when the security is being issued. Okay, so the first type of transaction is a primary market transaction, and this is where securities are issued for the first time. So an example would be an investor buys a share in an initial public offering. You've probably heard of IPOs before. When a company issues stock to the public, with the key thing being for the first time. Okay, so this is the first issuing of equity to the investors. So this is how companies raise funds in the form of equity. So any sales of shares in the primary market would actually raise funds for the particular company. More common, you hear an IPO, an initial public offering, but these can also be private. If it's private, that just means that it's not done on a public exchange, on a public financial market. You also have secondary market transactions. So secondary market transactions are securities traded after issuance. The key about secondary market transactions are that these transactions do not impact the company's financials at all. Okay, so these deal with an investor selling its stock to another investor after that stock has already been issued. So an example would be an investor who holds Apple stock sells his or her share to another investor on the NASDAQ stock exchange. Two other types of markets would be a third market. So with a third market, this is over-the-counter trading conducted by non-exchange member broker-dealers and institutional investors of exchange-listed stocks. That's a mouthful. This is from Investopedia, the Investopedia definition. Let's see if we can break it down a little bit more. So they are over-the-counter transactions, so over-the-counter trading, conducted by non-exchange members. So non-exchange would be they're not members of the New York Stock Exchange, they're not members of NASDAQ. So they are conducted by non-exchange member broker-dealers. So broker-dealers buy or sell for their own account or on the behalf of their customers. And so it's between these broker-dealers and the institutional investors of exchange-listed stocks. So stocks that are listed on the exchange. So non-exchange members are trading with institutional investors with exchange-listed stocks, but they're trading them over the counter. What is over the counter? When securities are not traded on an exchange. Some stocks only trade over the counter, but the third market is a special case of exchange-traded stocks trading over the counter. Oftentimes, securities can be purchased at a lower price because there's no brokerage fees here. This will add liquidity. Oftentimes, if a stock is traded over the counter, maybe it didn't meet the requirements of the exchange. But third market transactions are over the counter, so they're not on the on that like New York Stock Exchange, conducted by non-exchange member broker-dealers, so not members of the New York Stock Exchange or NASDAQ or some other exchange, broker-dealers, and they are trading with institutional investors, but they are trading stocks that are actually listed on the exchange. Adds liquidity. Fourth market is trading of securities between institutions on a private over-the-counter computer network. Once again, that's an Investopedia definition. Fourth market transactions are institution to institution. So these are dealing with different types of transactions in these financial markets. You also have markets being money or capital. This deals with the maturity of the securities that are being issued. So the other ones dealt with the types of transactions, primary, secondary, and who the transactions were between. These different characteristics or these different definitions deal with the characteristics of the securities. So a money market transaction or a money market deals with securities with a maturity of less than 1 year. Examples being treasury bills. So treasury bills are offered in 1 month, 3 month, 6 month, and 12-month increments, or 12 those maturities. With these money market instruments, typically they are low risk, low return. There's less chance of things going array in a short time frame as opposed to in a longer time frame. When I'm talking about longer time frame, I start to introduce capital markets. So with capital markets, these are securities with a maturity of more than 1 year. An example would be corporate bonds. You can have a 30-year corporate bond. You could have a 10-year corporate bond. But these are securities that are greater than 10 years or greater than 1 year. With this longer time frame, you're taking on additional risk. As a result, your risk-return trade-off, higher risk, higher return. So those were different financial markets. Now we move into the market participants. So who participates within these different financial markets? We are going to break it down into investors, broker-dealers, issuers and underwriters, and then just other different types of market investors. So market participants. So once again, a lot of definitions. Do your best to have the best understanding of these different types of participants. Jot down any notes that help you remember what these different characteristics are of these different participants. So there are three types of investors. The first being a retail investor. So this is an individual investor. So a non-professional investor who buys and sells securities, mutual funds, or ETFs, exchange-traded funds. This is like you or me. So this is you or me purchasing securities. We are retail investors. You also have institutional investors. These are companies or organizations that invest money on the behalf of other people. So large institutions like a large pension fund, that would be an example of an institutional investor investing money on the behalf of other people. And then you may have heard this term before, but it is an accredited investor. This is a sophisticated investor. So in order to be an accredited investor, you are defined as a high net worth individual, so a net worth more than $1 million or an annual income that is more than $200,000, or large institutions that have assets more than $5 million. So as an accredited investor, you can do things that retail investors cannot do. So one example would be investing in hedge funds. A retail investor is not able to invest in hedge funds, whereas an accredited investor is. Second type of market participant are broker-dealers. So broker-dealers, the first type of broker-dealer is a clearing broker. I'm just going to highlight some important phrases here within these terminologies or within these definitions. They act as a middleman between investors and a clearing corporation to ensure that the trade is settled and the transaction is successful. So they are that middleman between the investors and clearing corporations to make sure that the trade actually goes through. You also have an IB, an introducing broker. They advise clients in the futures market. We'll talk about what the futures market is later on this semester, but they delegate trade execution and back office operations to others. So they advise, but they delegate the actual execution to someone else. And then you also have a prime broker or prime brokerage. This is an investment bank who works with large institutions to offer hedge funds the securities they need for short selling, and they work with commercial banks to provide hedge funds with loans for leveraged trade execution. So what is short selling? Short selling is where you would borrow a share of stock. So you're borrowing a share of stock from some institution, and you are hoping that the stock goes down in price. So you would then sell that stock in the open market, bet that it goes down in price, and buy it back at that lower price, and then return the issue or return the stock to the institution. So that is what a short sale is. We'll talk about that more when we get into derivatives and that section, that unit of the course. But those are some broker dealers. The third type of market participant is an issuer and underwriter. So an issuer is a legal entity that develops, registers, and sells securities to finance its operations. This is an Investopedia definition. They could be corporations or they could be governments, and they could issue stocks or bonds. So they could issue equity or debt. And you also have underwriters. You've probably heard of an underwriter when you're talking about IPOs. So an underwriter is any party that evaluates and assumes another party's risk for a fee. So in a firm commitment IPO, an underwriter is the intermediary between the issuer and the investor, and the investors, and they help the company prepare for the IPO and sell the shares. So those that are raising the funds, and those are the ones that are purchasing the funds. But again, another one of these definitions that is going to be seen on the SIE exam, but we'll cover in more detail in later sections. Now just some other types of participants. Again, a lot of definitions. You have your investment advisor, is any person or group that makes investment recommendations or conducts securities analysis in return for a fee. You also have your municipal advisor, a person that provides advice to or on behalf of a municipal entity with respect to municipal financial products or the issuance of municipal securities. Well, what are municipal securities? We'll talk about federal government debt, but municipal securities are debt of your state and local governments. And then we also have a market maker. A market maker is a firm or individual who actively quotes. Let's get that out of there. Someone that actively quotes the price at which they are willing to buy a security and the price at which they are willing to sell. So this is what the price that they are willing to buy is what is called a bid price, and the price at which they are willing to sell is called a ask price. And so each stock on the New York Stock Exchange actually has a market maker. So they are saying what their clients are willing to pay for a stock and what they're willing to sell for the stock. But they are actively quoting the prices of buying and selling these different securities. Continuing with our definitions here, we also have some other types of participants in the stock market or in these financial markets, one being a custodian. So a financial institution that holds customers' securities for safekeeping in order to minimize the risk of their theft or loss. We also have a trustee. You've probably heard of a trustee before, whether it be in a financial matter or just on a family's on a family's home or a family's will. It is a person or firm that holds and administers property or assets for the benefit of a third party. So they are trusted to make decisions in the beneficiary's best interest. So oftentimes you'll have a bond trustee. That would be an example of a trustee. And then you also have what is called a transfer agent, a trust company or bank assigned by a corporation for the purpose of maintaining an investor's financial records and tracking each investor's account balance. So the transfer agent records transactions, cancels and issues certificates, and makes sure clients receive dividends or interest payments, basically helping out on the investor side and keeping everything in order. The key thing, I know that these are a lot of definitions, a lot of types of different market participants. The key here is that all of these participants help financial markets operate more smoothly, right? So you will see some of this terminology and some of these different roles or different types of participants in that SIE exam, so it is important to try to pick up on what they are now. But yeah, these all just help the financial markets operate more smoothly. Last up here today are financial institutions and regulators. So we've been dealing with financial markets previously. Now we're going to talk about financial institutions and then also regulators. So what are financial institutions today? First thing that you usually think about when you hear financial institution is you most likely think of a bank, right? So one type of bank, once again here before we get started, a lot of definitions, but we'll cover a lot of this in more detail in Unit 4, okay? A lot more detail in this final unit of the semester. So first type of bank that we need to know about is a commercial bank. So these are financial institutions whose major assets are loans and major liabilities are deposits. So deposits, because they have to pay those back, that would be a liability to pay interest on those deposits. Loans, they receive interest, that's why it's called an asset. So with a commercial bank, you accept deposits, you offer checking and savings services, you make loans. Those are some of the things that commercial banks do. You also have credit unions. Credit unions are a nonprofit depository institution, mutually organized and owned by its members. Here in Athens, we have the OU Credit Union. So with these credit unions, oftentimes, since they're smaller and they're mutually organized and owned by their members, you may be able to get a slightly higher interest rate on your savings accounts. But that's one of those things that you'll kind of just, you'll have to do a little research on comparing rates. You also have investment banks. So you've heard me use the terminology previously. These are financial institutions that help firms issue securities and engage in securities brokerage and securities trading. So trading. Really, this is related to the creation of new capital for companies, not just companies, but raising new capital for companies, governments, other entities Basically, so helping with new debt, new equity, mergers. Investment banks help in these different types of transactions. And then we also have insurance companies. Insurance companies, this is another type of financial institution that provides policyholders with payoffs in the case of adverse events. So really, insurance companies, help protect against losses primarily. What are some other financial institutions today? We also have pension funds. So pension funds are financial institutions that invest individuals' retirement savings into funds. So these individuals can withdraw money during retirement. So these are pooled contributions from all of the investors within the pension fund, and so they help to provide members retirement benefits. Okay, we also have mutual funds, so financial institutions that pool investors' money. Once again, pooling investors' money into portfolios of stocks, bonds, or other securities. Why is this? Why are mutual funds interesting? Well, by pooling these funds together, you can have a more diversified holding, so you can invest in stocks, bonds, and other types of securities in different industries, different types of different industries, really diversifying your portfolio. And they're also professionally managed. With hedge funds, these are investment firms that pool money from wealthy clients. Remember back to our other definition, what is a wealthy client? This would be an accredited investor, and also large institutions, and they invest using more sophisticated, often riskier strategies. So derivatives, margins, those are a couple different types of strategies that they may use. But with hedge funds, not everyone can just invest in a hedge fund. And then you also have venture capital. Venture capital are investment firms that pool money from individuals and or institutions and invest equity funds in startup firms. If you've ever heard the term angel investor or venture capital, those are not the same thing. They have similar concepts, but a venture capital, the key thing is they invest in startup firms. So those are some financial institutions. This last section of this second lecture is financial institution and regulators. Well, why do we need regulators? Thinking of sports, I'm a big sports fan. In the same way that sports games have referees, the financial marketplace needs to have oversight to make sure unethical behavior does not harm investors. So if you think to your sporting events, if you don't have a referee, things are going to go poorly, right? Something's going to go wrong because you don't have that oversight. Same with the financial system and financial institutions. So the four main types of financial industry referees who oversee the financial markets are the Federal Reserve, the SEC, the Securities and Exchange Commission, self-regulating organizations, SROs, and also then you have these other regulators. So what we'll do is we'll go into detail on each of these here on the upcoming slides. The first is the Federal Reserve, also just known as the Fed. They are an economic body that oversees financial institutions and also play a major role in financial markets. Now, if that is not a basic definition, I don't know what is. We go into so much more detail on the Fed in the next section, actually. So we are going to really get into the specifics of how they oversee financial institutions and how they play a major role in financial markets in the next section. They are a very large body that oversee the financial systems. You also have the SEC, the Securities and Exchange Commission. So according to their website, the mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. So really what they're doing is they are overseeing the key participants in the securities world, including security exchanges, security broker-dealers, investment advisors, and mutual funds. So those market participants, they are overseeing what their actions are within the financial system. They are concerned primarily with promoting the disclosure of important market-related information. So the disclosure of important market-related information, maintaining fair dealing, and protecting against fraud. So we know that all publicly traded companies must submit certain documents with the SEC in order to be traded on within the secondary market. So you got like your 10K. You got 10Qs, you got 8Ks, you've got these different financial reports. This is part of how the SEC actually helps with making sure that information about companies is presented to all those investors. So they really want to know, do investors have enough information to actually make an informed decision on these different types of securities? Additionally, the Securities and Exchange Commission decides whether a firm making a public issue, so your IPO, has provided enough information for investors to decide whether the issue is fairly priced. They also require exchanges to monitor trading to prevent insider trading. So insider trading is when you use inside information that the public doesn't have. So maybe you're an executive for a company and you know something's about to happen, but the rest of the public does not know, and you trade on that information. That is illegal, and the SEC monitors that to prevent it. It also attempts to reduce excessive price fluctuations. They actually use a thing, what is called a circuit breaker, where if there's too much volatility in a stock, they'll cut off trading of that stock. And then they also monitor the major security exchanges. So, the New York Stock Exchange, NASDAQ, the SEC monitors these exchanges. Some other regulators would be SROs. SROs are self-regulatory organizations. So they are a non-governmental organization that regulates certain professions or industries with the aim of putting up rules to promote order among business. So once again, that's just the definition of what an SRO is from the Corporate Finance Institute. And you also have FINRA. FINRA is the Financial Industry Regulatory Authority. So they regulate broker-dealers to protect America's investors by making sure the broker-dealer industry operates fairly and honestly. They are very closely tied to the SIE exam. Okay, so that SIE practice test is actually on the FINRA website. There's also a lot of other information on FINRA that you might find interesting. So one thing that I would do if I were you is kind of just go to the FINRA website, play around a little bit, and see all the different types of information that are available or that is available on that website. Some other self-regulatory organizations include the Chicago Board of Options Exchange and also the Municipal Securities Rulemaking Board. Some other regulators, just listing these off, you have the Department of the Treasury, you have the IRS, you have state regulators, you have the Securities Investor Protection Corporation, and you also have the Federal Deposit Insurance Corporation, the FDIC. As I mentioned previously, FDIC protects deposits in FDIC-covered banks up to $250,000. So if the bank were to go bankrupt, you're covered on your deposits up to $250,000. So a quick review of the concepts. Make sure you can answer these questions. So what are the types of financial markets? Who are some market participants? What are the main types of financial institution? And also the main regulators of the financial system. I realize that today's discussion was a lot of definitions, not very, just a lot of regurgitation. But this information is covered in that SIE exam. It would be wise to try to learn this terminology and learn these definitions now. So once again, if you have any questions about anything with today's discussion or today's lecture, please don't hesitate to reach out, and I will talk to you all soon.